Welcome back, everyone, to Vox Markets Live. My name is Paul Hill. I'm delighted again to be able to speak to equity analyst and stock market commentator Paul Scott to discuss all things small caps. So welcome, Paul.
Thanks again, Paul, and hello to everyone on the live feed as well.
Yeah, well, it's great to have you back on the show. We've got lots of macro news and company news to discuss today. Not least, we've had hot and expected inflation data this side of the pond in the UK. Plus, we've had a sort of deterioration, unfortunately, in business confidence. But before we sort of run through some stocks, as we normally do, have you been buying or selling anything over the last couple of weeks at all, Paul?
I'm trying to think. Nothing significant that I can think of. I tinker around, with all these sort of fun money microcap type things. But no, I don't think I've really done it. I can't remember, to be honest, but nothing significant anyway.
Yeah, no, I managed to.
How about you?
Yeah, well, I got rid of my my Roche shares, which the pharmaceutical company based in Switzerland. I did it largely because I was heavy into healthcare, and Trump was threatening tariffs on the import of pharmaceuticals into the States and stuff. So that's not going to be very helpful. And also, there's been a sort of a blockage, as I've mentioned before, in the FDA. So I decided a small sort of I took a small profit and I've had dividend income, but it just cleaned my nose on it. So I've got a bit more money for investment opportunities, no doubt about it. And then also, how's your top 20 doing this year? Because mine was doing okay for the first 3 or 4 weeks, but I've had a bit of a bombshell. So how's yours performing?
Well, my top 20 is flat, but I also did a runners-up list of 24 different shares, and that's actually up about 3% year to date, which is not bad. So yeah, maybe I should have gone with the lower conviction shares.
Well, the thing is, you don't know, do you? When you go into, you select some shares, and you have obviously you pick 20, and they're all evenly weighted, which is not in reality, because I think you run your money slightly the same way as I do, but you do that, and you don't really know which ones are going to do well. But one company which has done very well, I think, in your main top 20 is Beeks Financial, which came out with another storming exchange contract win, this time in Mexico, having won Joburg and Nasdaq. Obviously, it provides cloud services for low latency sort of dealers, high frequency traders. How do you see this one going forward? It's obviously done really, really well for you. I think you own it personally as well, don't you?
Yeah, I've been a long-term bull on Beeks, and my view is very, very good. I mean, they've told us that it had more exchange cloud deals in the pipeline, and these are the biggest contracts basically with stock markets. And funnily enough, what management said not that long ago actually was counterintuitive, that it's actually the kind of secondary and tertiary type stock exchanges, like, say, for example, important ones but more regional, like, say, Johannesburg, that are actually more lucrative for it than the giants, because everyone who wants to connect to Nasdaq probably already has done. So although it's a nice sort of little add-on service they're offering, I don't think Nasdaq will necessarily be as big as they think. Whereas this latest contract win is the second largest stock exchange in South America, in Mexico. And the broker note actually indicated that they reckon it could be bigger for Beeks than Johannesburg, which has been very, very good. And these contracts tend to land and expand. Joburg doubled when they decided they wanted it at a backup location as well. So no, the outlook is very, very good for Beeks. So the shares, as you can see, they spiked up to about £3.20 on Wednesday afternoon when the Mexico deal was announced, but then went straight back down to where they'd started from the following morning when a trading update came out, which was only in line. And I think with these highly rated growth companies, people want to see ahead of expectations, don't they? So I can understand why maybe one or two traders just decided to bail out, but I think they're missing the longer term. This is a long-term, very high organic growth story. And in my view, I anyway, ignore the day-to-day price movements completely. I've done my research. I'm happy with it. And I think the new contracts obviously have a lag until they become live. So you wouldn't expect it to be ahead of expectations because the revenues kick in once it's implemented and goes live, which can be 6-9 months in the future. So there's nothing untoward whatsoever about it. It's just one of those stocks that's difficult to value, looks expensive on value criteria, but growth companies always do, don't they?
You sound a bit like me there, Paul, because I'm with you. Yeah, you do, in terms of this is not a cheap stock, but frankly, when you look back in 5 or 10 years' time, it'll look extremely cheap if it carries on its trajectory, if it wins more exchanges. And you just got to accept it's going to have volatility at the high level. People will take profits on the way, but if you basically don't get thrown out by a small or even a large, drawdown, because the fundamentals are still strong, in longer term, 5-10 years, you're going to be laughing all the way to the bank. You're crazy dropping it,
Yeah, this is why I think it's one to own outright rather than use on a spread bet, because then you don't have to worry about. And it's such a pity where you see on those dips down on the chart, you see people panicking on the bulletin boards and saying, "Oh, I can't take any more pain. I've sold out." And they nearly always, days later, it'll shoot back up again, and then they're buying back in at the higher price. So I think you do your research and then you stick to your guns, unless something really fundamentally deteriorates. But it certainly hasn't done at Beeks. Everything's fine. I don't think you need to raise any more cash either.
Yeah, no, I mean, I can't believe, to be perfectly honest, it won NASDAQ, which is just incredible against the US competitions, and now it's she'll just mop up lots of other exchanges, because they'll just have they'll want to do the same as NASDAQ, and they'll just have a preferred sort of like supplier list of one, and it'll be Beeks.
I think you could well be right on that. I mean, that's the attraction of this. They seem to be getting this niche sewn up, So I'm very pleased with Beeks. It's done well for me so far. Fingers crossed. All good so far.
Yeah, well, okay. Well, if anybody wants to ask Paul any questions, please put them in the chat button and I'll read them out. We got a couple here on the same company. We've got JKR Investing, and we've got
hello, Jacob.
Yeah, and we've got Arbel. Both of them asking about your latest thoughts on Jet2, the low-cost airline that also does package holidays for sort of families and stuff. And I think it came out with some decent results this week, but the outlook seemed to be less certain than it has been in the past with visibility. But how did you read it?
Yeah, exactly the same, Paul. I mean, I did a write-up on it. Here we are. It was Wednesday this week, the 19th. I'm very positive about Jet2. I mean, I don't normally like airlines, but this is such a good business. If you look back, I followed it right from the days when it was, below a pound, 76p, I think, when it first caught my eye, when it was called Dart Group. And it's been an extraordinarily entrepreneurial growth story. And they have it's obviously, as you say, but it does very well now in package holidays as well as just the flights. Superb customer scores. It's just a lovely, lovely business. It's got a fantastic balance sheet that their broker described as a fortress balance sheet, which is a good description. So it earns a ton of money for finance income from the cash deposits, its own and the customers. Owns a lot of the planes. It's got, I think, forward orders in on planes at favourable prices. It's just a lovely, lovely business. And I'll be able to mystery fly it soon, because they're opening up at Bournemouth Airport in this year. So I'll book some flights and I'll report back. But no, I think it's very, very cheap. The shares, I think, are just the wrong price, the way I look at it. It's in a single-digit PE ratio, bulletproof balance sheet with loads of net cash. Now, even though the market took this as a profit warning, maybe technically it was slightly. The shares dropped 11% to £14 on Wednesday, and that was, as you correctly say, because of the outlook comments where it said, quote, profit margins may come under some pressure, and it mentioned a number of factors like wages and so on. But that's the normal day-to-day ups and downs that I would say for any business. I don't know why you would sell unless you're a trader on that announcement. And I just think it's so appealingly cheap. I don't hold myself, but I probably should.
Yeah, I mean, we'll get another wet summer, won't we? And everybody will sort of will rush to book up in sort of like springtime, because the summer's looking terrible as we had last year, and they'll do booming. But yeah,
and they've specialised in these. more minor airports, which are so convenient, particularly in the Midlands and the North. They're so convenient for people that, a lot of people who live in the Midlands and the North have told me it's just their go-to airline, because it's so much more convenient than having to hike down to Gatwick or wherever else. So I think it's just a lovely business. The shares are inexplicably cheap, I think.
Yeah, no, I would agree. Okay, let's just move to another share that reported. We hardly ever talk about Wilmington, which is basically a specialist training stroke data provider, largely for regulated industries. I think the financial services, if I remember rightly, has been a darling, and quite a few fund managers like it. How do you see this one going forward?
I've always liked Wilmington. I mean, if you zoom out a sort of 5-year track record, it's done tremendously well. It's doing acquisitions as well. Now, I think this reported on Tuesday, I think this week, didn't it? Now, this confused me, I have to say, because I read the update and thought, that's fine, it's good. And the shares just dropped and dropped and dropped. I couldn't work it out.
Sounds familiar.
Yeah, I know. A lot of shares are doing that at the moment. It's really confusing, this market at the moment. It dropped 15% in 2 days combined to £3.17, and I thought I've got to go through these numbers properly. So I spent 2 or 3 hours on it. This was the H1 results. It said that the figures were great for H1, and the outlook for the full year was in line. And I think the broker forecasts were unchanged. I can't remember off the top of my head, but there were a couple of minor niggles in the accounts, but really nothing of any significance. So I just concluded, I don't know why it sold off. Looks like a buying opportunity to me. And anyway, I think in the last couple of days, it might have bounced a little. Have you got the latest price, Paul?
It's up 2% today anyway. Yeah,
it was £3.17 when I wrote about it. So, and I couldn't understand why it had sharply dipped. So I see this, maybe less so now, it's bounced, but I see that as a good quality company, very reasonably priced, and I think it's potentially a bargain. They're also, it grows by acquisition, doesn't it? It's buying up health and safety orientated training businesses, and I like the strategy, which is to divest anything low growth and low margin and to focus on buying companies that are higher margin and higher growth. Well, that seems to me absolutely spot on. And they seem to know what they're doing with the acquisitions. So, I like Wilmington. How about yourself, Paul?
Yeah, no, I think it's a class act. The one sort of thing I would watch going forward is that now that Trump and the UK, in fact, Europe as well, they're talking about deregulating lots of industries like financial services and also health and safety to a certain extent. And on that basis, if they start stripping out red tape and rules that people have to know and follow, then you can see, basically less demand going forward. And you got a case of that, or an example of that, when was it Learning Technology Group came with a profit warning, even though they're being bought out about 3 weeks ago. And that was simply because Trump decided, okay, we're taking this regulation out on, because they're obviously learning, and the whole area that they were experts in learning, suddenly they didn't have to learn because the rules changed. And I suspect you might find this could happen in financial services. The thing I like about Wilmington is about 75% recurring revenue streams.
Yes, you're right. Yes, good point.
It's got very, very good visibility, but there is if you're in a regulated area at the moment and you're benefiting from regulation and always have done from tighter regulation, then you just got to ask the question: is this a space that potentially could get some of that red tape stripped out?
Yeah, I have to say, just coming back to you on that, I think in the UK that's very unlikely, because all attempts at deregulation in the UK fail miserably, because the Whitehall blob bring in as new regulations just as rapidly as old ones. So no, in my lifetime, no government has ever successfully deregulated. Thatcher did a bit, but it seems to creep back. So whereas I think in America, it's a very different picture, isn't it, with what Trump's doing and Musk. What a bizarre situation, isn't it?
Yeah, I mean, they're very Marmitey type characters, but you can one thing which does stand out to voters throughout the world, I'm sure, particularly in the West, is how much they've changed and what they've done in terms of just activity levels, mainly, causing chaos, but actually, changing things. And frankly, we've had 6 months of, since our election, just over 7 months, 8 months or whatever. And I mean, Trump and Musk, and they've done so much, in their 3 or 4 weeks compared to what we've done in nine months. Whether it's right or wrong I'm not saying that. I'm just saying there's the level of activity. They've really grabbed what they think is the right way forward.
Yeah, I think you're right. Britain's a completely different case, because there was a very interesting article from Dominic Cummings recently, who said that basically and I think Musk said something similar recently, we're not actually living in a democracy, we're living in a bureaucracy where politicians of any colour can't actually significantly change anything. And I think and so nothing will change whoever's in Downing Street. And I think that's a very compelling argument.
Yeah. So you never know.
So in terms of shares, that's why, unless Wilmington has significant US exposure, then I personally wouldn't be that bothered about deregulations happening in Britain, because it's just not going to happen.
Yeah, no, you're probably right. Okay, one company we did chat about last week came out with some really big news, which is Tracsis, the sort of hardware and software expert in all things rail in the UK, and is also branching out to the States. And it won this huge contract with Network Rail to do tap and go across all the urban centres across the country, and they've already do 6 and stuff. How do you, and also hidden in that statement, there was a quick trading update saying they were actually going to meet their expectations for June ending July, and they would give a outlook in a couple of weeks' time. How did you interpret this one? The shares responded pretty well.
They did very well. I think you and I were both on this at 7 a.m. on Wednesday.
Yes.
We both. I obviously in my Substack, where I review all the day's RNSs, I don't want to give any buy or sell advice. It's just interpretation. But I came the closest that I dared on this, saying with Tracsis, I put this out at about 7:50. Said, look, this could be a game changer here, because we spoke about this last week and maybe the week before. That Tracsis was just in a nosedive, wasn't it? Information vacuum, everybody assuming it was going to warn on profits because of the delays to the rail, whatever it's called in Britain. And then finally we got a trade. Contract win announcement. And I would caveat that by saying, Paul, potentially huge contract. I think it's only a tap and go thing from a very low base to begin with, but it was big enough to knock 6% off the shares of Trainline on the same day. And as you say, buried near the end of the contract win announcement was, it didn't actually say in line with market expectations, it said in line with the board's expectations, but that's splitting hairs because it's nearly always the same. So I think when a share's in free fall like that, this is precisely the type of announcement you want to signal to you that it's a turning point. So I said, look, I think this is going to go up today. And in the first hour, it only rose about 4%. So people had 1 hour to actually stock up on their Tracsis shares, and by the end of the day, it was up 20%. So that was a lovely trade for people who were paying attention. I think it might have given a little bit back, but not much. Oh yes, you've got the chart there. So I missed that initial. Well, I didn't have any cash available, so I miss it. As a story of my life, I always miss these good opportunities, and I didn't want to pay 20% more. So it's now on my buy the dips list.
Yeah, it'd be interesting to hear what
did you grab any, Paul?
No, there wasn't enough liquidity. Even that first 2 or 3 hours, you just can't buy any in volume at a reasonable price. It was just that was trading at minuscule volume. It was anybody wanted to buy anything of note, it was going to shoot up. There was nobody selling basically.
That's the trouble, isn't it?
Yeah, but frankly, I'd be very interested to hear what they say about the outlook on the 27th of February, which is next week, because I was surprised they didn't include that as well, having given a trading update. And what I suspect that is they haven't yet worked through how the contract, the timing of the revenues and the costs and the funding which is going to be required for this particular contract, how it's going to pan out for the next year. And so I think it's going to be quite important on the 26th, both positively and potentially negatively, depending on how they guide their brokers.
Yeah, interesting. And didn't they say, just something that popped into my head, I think they might have said that it was customer funded
They said it was funded,
development?
fully funded.
Fully funded. Yeah,
They
yeah.
didn't say it was customer funded. They said it was fully
Oh,
funded.
oh,
Remember, they've got they've got about 18 million of cash on the balance sheet. So
they do. Although the net tangible asset value isn't particularly big at Tracsis, it just has favourable. It gets paid up front by a lot of customers. But
yeah,
you're quite right. It does. It's got a comfortable balance sheet, a small but comfortable balance sheet with some surplus cash. Yeah, I think
yeah,
it's nice, Tracsis. I mean, at £9, £8, it was just far too expensive because it's a bit of a hodgepodge of
yeah,
these transport related businesses. Some of them are very, very good, very sticky recurring revenues, mainly the rail software stuff.
yeah,
Some of the other bits, particularly, they got something to do with car parking, and they got a few other bits that frankly are not very interesting at all.
mm.
But yeah, very interesting at this sort of level. I think this is a share that maybe might be, I'm tempted to just pick up a few, tuck them away and
Yeah.
forget
No, so
about
am
them.
I. Yeah, no, so am I. Okay, we've got a question from Ben Sharman. He's asking about Springfield Properties, the Scottish house builder. Came out with a big sale, actually, to Barratt of some land that meant that they took a shed load of profit into this year and took out a bit of profit from the following years. But how do you see this one? The shares responded pretty well.
Yeah, I really dropped a clanger on this because what I did was I looked at, because what it is, I wrongly labeled it as a profit warning.
Mm,
And then I think it was equity development. No, and Rebecca, one of my readers, Rebecca, and somebody else got on to me and said, "No, hang on a bit, Paul, you've misinterpreted it." Yes, I think it was equity development. Because what they'd done, as you say, they pulled forward some land sale profits, which was an outperform statement for 2025, and then the brokers reduced the subsequent 2 years profits. Now, what I do, the reason I made that mistake was because I find that trading updates are from some companies are so completely dishonest that they're terrible. They don't go naming no companies. It's a generic thing, but they put out a trading
Don't mince
update.
your words there, Paul.
Well, no, it's true, Paul. We all know it's true. You read a trading update, you think that's not too bad. Then you look at the price and it's down 40%. And you
Yeah.
think, what the hell? And it'll be because they've slipped out a big downgrade through a broker note. So for that reason, my definition of a profit warning is not what's in the RNS, it's what have the brokers done. So of course I looked at Springfield and thought, they've lowered expectations for the next 2 years, so it's a profit warning. So anyway, I got that wrong. So I'll have to check that. So apologies to everyone, but I still said I like the share though. Yeah, so it's green on my traffic light system. Very, very good. You've got it's a Scottish house builder. It also said, I believe, that the substantial land sale is about half the market cap was to Barratt's. It's
Yes.
spread over 4 years, and I think they said it was 130% of book value. So and now you can buy the shares at quite a significant discount to net tangible asset value, which I think is about 30%. So I think this share is on an unjustified discount. I know quite a few house builders are cheap, but this one's definitely. And also, I've got sources, investor friends in Scotland, who say this has got a lot of value in it. They know that where the land is, and do you know what I mean? So some really smart, shrewd investors I know in Scotland have looked into this in a lot of detail and said it's the real deal and it's undervalued. So I respect their views, so I like it a lot. Yeah, so it's green. That's the equivalent of 5-star in my personal rating system. So have you looked at this one, Paul?
Yeah, I mean, you just raised a very good point because their net tangible assets I had at about 130p. But if you actually put on a 30% uplift to their land sale of 60 odd mil, then you're adding another 20 mil, which is another sort of 15p per share. So you get to a net tangible asset of 145, and this is a £1. So yeah, you've still got plenty of, you got another 40% upside just on your net tangible assets. And I'm with you. I think what's happened is that they've sold the big central land, land in central Scotland, but to concentrate on the north, which I think is now there's a lot of development for things like the offshore wind for energy.
That's right. Yes, that was it. It's coming back to me now. A conversation I had. I think they've got hidden value there from selling or leasing bits of land for the cables to go to the wind farms and all that. I think that was a sort of kicker on this.
Yeah.
So it's very good, I think.
No, I would agree. Yeah, I think that's a really smart sale, actually, that land sale, to be able, because they'll be able to control almost a lot of the land, but one of the only developers in the north. So yeah, you're right.
Yeah, and it de-gears the business as well. I think they've said a lot of people were flapping a bit, I think unnecessarily, about the level of debt at Springfield, because it always had, substantially more than the debt in assets. So it was never a concern to me. But I know some investors did think the gearing was a problem. Well, it basically said it's going to de-gear over the next, I think, year or two. From these Barratt land sales. So yeah, all good, I think. I don't hold personally, but I should have bought some. But I didn't.
Yeah, I was one of those doves flapping as well. So on that one, it was a bit heavy on the debt for me. Okay, we got a question from Andy2205. He's asking about Intercede. He says the shares have dropped, and he reckons, is it anything to do with the US Doge? Because you've had Trump having a go at all the defense companies out in the States, and their share prices have been knocked. So you've had things like Boeing and Northrop Grumman, and there's another one. There's a massive one. I can't remember what it's called. Big airline, Lockheed Martin. The other one, there's lots of, and they've been hit because they're going to take down defense spending by 8% per annum for the next 5 years, or they're threatening to. He's just wondering whether is Intercede involved in that, and if it isn't, what's causing the downturn?
Well, I mean, there's been no news from the company, so we'd only be speculating as to why people might be selling the shares. And I don't really see any merit in that, really. But I mean, all I would say is that because Intercede is mission critical for two-factor authentication for IT systems, it's not discretionary spend. It's embedded into numerous US government departments and major corporations. It's not it's not like getting rid of a charity distribution division or buying fewer tanks. It's just totally embedded into those departments, I think. So I'd be very surprised if Intercede is affected in any way at all. But if anything, the edicts from US government departments have been that they want more security on federal IT systems. So I doubt very much whether cybersecurity would be a target for cost cutting. But look, I don't know. I could be wrong. What do you think, Paul? Do you see it as a risk?
Yes, but the only reason I do, 2 days ago, you had the poster child of all things cybersecurity and data management in defence. I just slipped my mind, but there's basically a massive company that also does it for the UK healthcare. He came out with blockbuster numbers, and the shares sold off by about 20% on the back of the announcement for the defence cuts. I can't remember. It's a huge, really well known one, but it's terrible when you've had it on your tip of your tongue and then you forget it. But I know it's there.
Yeah.
Okay,
that happens when you're in front of a webcam. Sometimes your mind just seizes up.
No, you're right. Yeah. Okay, we got a question from Paul the Parrot. He's asking about Zytronic, which I seem to remember is basically a touchscreen business, is it, or something like that?
It's a special situation now. Yeah, it was. It basically shut itself down. I mean, it's so small. We should just a very brief mention on that. There was a really negative update from it recently, just saying they couldn't find any buyers for the operating subsidiary, and they couldn't even find buyers at acceptable prices for the equipment. So I think what that basically means is, and they said they brought in FRP advisory to do an orderly wind up. Well, we all know what that means: bumper fees for FRP, and it sort of raised questions over what I don't think they've said what ultimate distribution might be available to shareholders, but they're kind of signaling, I think, that it may not be much or anything. I did check their annual report, though, for Zytronic, and I noticed that it does have about 3 million of freehold and long leasehold property. So I would work on the basis that the remaining 3.3 million cash is probably all going to, I imagine, will get swallowed up with all the shutdown costs. Because remember, you got all the when companies are no longer a going concern, a whole bunch of new liabilities pop up, like terminating leases, terminating employment contracts. To actually make it clean, to be able to give a shareholder distribution takes a long time. I used to work in insolvency, and I mean, some of these cases could run for years. So my view is anyone holding Zytronic should seriously consider, obviously their decision, their money, seriously consider just ditching them in the market, because I think once it's delisted, you won't have that opportunity, and you could be waiting years before you get any distribution at all, and it may not be anything. We just don't know. So why take the risk?
Yeah. No, you're right. No, the share that I was trying to remember as well is Palantir Technologies, and you can see it's done. It's good. Yeah, no, it's the poster child. It's a big American one. It's done really, really well, but it took a bath at the top. So if I just put it out into minutes, then you'd probably see there it's gone down.
It's funny if you'd mentioned some tiny nano cap, I'd know it inside out. But a sort of multi-billion pound mega core, I've never heard of. No, I have heard the name, but I don't know anything.
Yeah. No, that was.
Well, that's a volatile share price, isn't it?
No, they all are these things. They're, particularly when Trump throw bombs and stuff at the sector. Now you mentioned FRP Advisory, the insolvency stroke financial services, all a bit of corporate finance and stuff like that. How do you view this one? Again, it seems to be doing pretty well in its insolvency, even though the economy's ticking along. Any views on FRP? Looks reasonably cheap.
Yeah, it is. Unfortunately, I didn't get a chance to go into it in any detail. It reported, I think, was it this week or late last week or something? Yes. Yeah, I think it was ahead of. It's coming back to me. It was ahead of expectations, I think, and the forward PE has reset down to quite a low level now compared. It always used to be sort of on a high teens forward PE. I think it's now on a low teens forward PE. I know PE isn't everything, but for more mature type businesses like this one, it's still my favorite measure. So I think this looks quite good. I'm sorry I haven't done any more detailed work on it, but
it's got market cap's 360. It's got nearly 30 million of net cash. PE ratios is 13.5 or 13.3 forward, nearly 4% dividend yield. So if you think insolvency is doing well, and corporate finance, when we get some the IPO market coming back, then these could do pretty well, I would have thought.
Yeah, I think usually you got Begbies Traynor, of course, which reported yesterday or the day before. Now that one I think is even cheaper. That one I did report on, and I'm green, so 5-star. My view of Begbies, it's on a forward PE of 9. I think you've got a similar dividend yield to FRP of about 4.3% ish. I think Begbies' balance sheet's okay. The trouble, the main drawback with these insolvency guys is they have a very large receivables book.
Yes.
But you can't get away from that. That's just the way it is. And, they've got very favorable supportive macro conditions. Begbies indicated that the pipeline was very strong, that obviously they're counter cyclical. So when companies are lining up to go into administration, it's these guys who make the money from that. So, and usually when the economy is flat or struggling as it is at the moment, normally these shares go up quite a lot, but they haven't done this time, which I think is irrational. So I think both of these shares, FRP and Begbies, are both undervalued by, I would estimate, about 30%.
Yeah, no, good spot, that one.
Yeah,
okay, we got Peter Oakcroft. He's asking about just generally microcap investment companies trading at excessive discounts, and he talks about one I've never even heard of, basically, but it's mineral and financial investments. And I've just put the chart. Well, you've just got the chart there, haven't you? Look at it. I mean, it's doubled in about I don't know 2. I've got no idea why that is, and I'm not really sure what the market cap is, but just generally on micro cap investment companies, discounts to investment trusts. Personally, I think there's some quite good value out there where you see trade. But what are your thoughts?
Unfortunately, it's one of these things where I don't have the time to look into them because they take I can't do quick reviews of them because you have to drill into what positions they all hold. But I know certainly REITs is an area, as we've talked about a few times, that I've been dipping my toe into. And I think there's some obvious bargains there with fabulous dividend yields. And I'm told by experienced investors who I rate their judgment that investment trusts are in a similar basket, where you have obviously a closed-ended fund, so you don't have to worry about them having to make any redemptions because they don't have open-ended structures. So and you can drill into what they one of my readers, it was actually John from Twitter, he mentioned one today. I can't remember the name of it in the reader comments. So yeah, I think, look, sorry this is also vague, but I think
yes,
definitely a good area to be digging into, doing your own research. And I'm sure there are definitely bargains in investment trusts for sure.
Yeah, and I think anecdotal evidence is that Saber or Saber Capital has had a pop at all of these investment trusts just recently, exactly because of that, because of the discount. So if you can find one which is still trading at a discount, then you're probably quids in to a certain extent.
Yeah, and it's quite interesting looking into what they hold, and then you can work out whether you think the positions in the trust are any good or not. So yeah, interesting area if you've got the time.
Yeah, no. Peter, just a question for you. It's not a question, a request. If you've got any reason, just put them into the chat box of why those shares have doubled in 2 months. Then we'd be interested. Obviously, they've got some rocket ship investment that has done really well. Okay, yeah. We got a question from David Raywood, CREO Medical, which is basically a oh crikey! It does minimally invasive instruments for in surgery, etc. And it's a really important deal with surgical instruments, with Surgical Intuitive, which does the Da Vinci machines and allows really sort of keyhole surgery in individuals. But I think it's sold. It's 51% of its European business. It's big cashed up. And it's sort of like a race to get to profitability for its sort of technology. I don't know if you've got any thoughts on this one at all, Paul.
Yeah, I covered this one on Monday, on 17th of February. It's an interesting company, no doubt about it. It's got, as you say, a promising sounding medical device, but it's very commercially, it's unproven. They've only basically done pilot or trial type sales. Sorry, excuse me. But they're cashed up. They've just received very recently £31 million or euros. I think it was all dollars. I think it was pounds. After this, they just pulled a rabbit out of the hat with this disposal of a consumables division that doesn't make any money, but it obviously had value to an acquirer. So that's radically improved the picture for CREO. 78 million market cap. That was at 17.5 pence. Cash runway, it's a big cash burner though. So, but I've calculated, I think it's got at least about 2 years cash runway before it burns through this 31 million. So they've got a 2-year window to commercialize this new, I think it's called Speedboat.
That's it, yeah.
Something like, no, not Speedboat,
It's called Speedboat, you're right.
Yeah.
Yes.
It sounds very interesting, but how on earth can I assess whether a minimally invasive catheter, I think it is good or not? You'd need to really consult medical experts, wouldn't you, or somebody who's mainly used or assessed the product. So really, it's a punt, I think, for ordinary investors. You're just gambling really that it's going to commercialize this, or at least be in a credible move to commercialize it before it runs out of money in 2 years' time. So. Yes. I don't know and trouble is somebody will come along and buy the company if it's if the product's any good, won't they? So I think you've looked into this a fair bit, haven't you?
Yeah, I love the technology. I think it's really good. It's leading edge. Da Vinci wouldn't have actually partnered with these guys unless it was, but they'd go to the US player. Right. They're doing sort of like pilot preliminary trials to make sure it sort of works on sort of like cancer on sort of tumors and stuff like that, particularly in difficult and soft tissues like cancer in lungs and stuff, and your pancreas and this sort of stuff. So if that comes through positively, I'm sure Surgical Intuitive are going to buy them because it's just perfect fit for them. And what was quite Surgical Intuitive, I think it's Intuitive Surgical. That's it. Which is the Da Vinci owner, they're a massive US company, medical devices company.
Yes.
Sorry, I should have explained. But what was quite interesting, I think, was I think it was the chairman or one of the CEO backed up the truck on these shares at about sort of 15-16p and bought a couple of £100,000 worth just not recently.
Oh, that's a nice spot. Yes, that's a good signal. That's a good signal, isn't it? Yeah.
So somebody knows what how's that doing. Okay, we got Rob. He's asking about Assetco, which is basically a hybrid fund manager, owns River Global, which is the old River Mercantile, plus it's got a couple of other fund managers, and it's got the 30% owning in Parmenion. It's a bit of a special situation unbundling. Christopher Mills is in there on the board. Its chairman is Martin Gilbert. I don't know if you've got any thoughts on this one.
Unfortunately, ASTO, it doesn't
Yes.
ring any bells. Keep talking, Paul, and I'll look it up.
Yeah, no, I mean, I'll just put it onto the chart, etc. It's basically a sum of the parts story. The shares are currently trading at 32p. Let me put it up. There we go, 32p. If they're 30%, if you believe the sum of the parts, their 30% stake in Parmenion is worth roughly around about 50 to 60 or 70p a share, depending on what they can sell that for. And then you've got basically 15 or 10 million of cash on the balance sheet, which is, again, I think is about 100 million shares in issue. So you've probably got another 10p. And then you've got whatever River Global's worth. It's not profitable at the moment, but it's got a couple of £1 billion under management. So let's say 20 million. So effectively, you've got anything between 60p a share to £1 a share of value if they can realize it, and that's the sort of the upside opportunity, I think, in it, or it gets bought out by somebody like Premier Miton.
Yeah, I've got to say, I've been searching my archive while you've been talking, Paul. I don't seem to have covered this one, so but I think you've given a good synopsis of it, so I can't add anything to that, I'm afraid. Sorry.
Yeah. Okay. We got one from Kev Allen. He's asking about Journeo, which again is an expert largely in hardware, but it does have some recurring revenues in rail, largely in the UK, or transport in full stop, but it's rail transport and stuff like that. Got some quite neat technology. The shares have been a bit of a darling over the last 3 or 4 years. How do you see this one at all?
We've spoken about this a few times before. Yeah, I like it. I think it's good. Management seemed to have made a highly successful acquisition or acquisitions, because it was a bit of a sleepy nano cap before. It's much better now. Forward PE on it at the moment on Journeo is 10.9, which is probably about right for it is a contract, a lumpy contract type business. So I wouldn't go crazy on the valuation. I think last time I looked at this, I was quite positive on it. So yeah, I think it's so far so good, but you just never know, do you, whether they can keep winning the contracts they need with this type of business. I don't think it has much recurring revenue, if my memory serves me correctly. Oh, here we are. I wrote about it on the 14th of January. It was a slightly ahead trading update. Oh, no, my colleague Dave wrote about it. Anyway, we concluded there were plenty of positives, but that we thought it was up with events. That was at £3 a share. So I think it's 10% cheaper than that. And we concluded moderately positive, amber green. So yeah, what do you think, Paul? Is it one you've looked at?
Yeah, I like it. It's just a good solid business with good management, and they seem to be executing, and they don't seem to have been impacted at all by the delays to the rail CP, whatever it is, 6 or something like that. The rail sort of roll like that 5-year plan, whereas lots of other companies have, like Costains and Van L and people like that. So yeah, no, they seem to be doing pretty well.
And they're doing buses as well, aren't they? I know they're doing the electronic signs for the bus stops and for the railway stations. They're also doing these retrofit wing mirrors, aren't they, for buses?
Oh yeah, that's right. Yeah,
will stop them mowing down cyclists and pedestrians and things, which looks very worthwhile. And CCTV systems they've traditionally done. So it does look interesting. But as I say, I don't know whether there'll be gaps in the order books, which we've seen a few companies, haven't we, where there's just a sudden unexpected delay or cancellation. Now, so far, so good. We've not seen that from Journeo, but it is a latent risk, I think, possibly. Yeah. Oh, I think the Bulls were telling me as well on this one, on Journeo, that it spent a lot on product development. I think it does innovate. And so it seems a decent company to me, but I don't know how it'll perform in future.
Yeah, Peter Oakcroft has come back on that mining and minerals company. It's got a holding in Lucer Mining. which is up 350%, and it's got exposure to gold as well. So well done there, Peter. You've bagged an absolute bargain to double your money.
It just shows, doesn't it? Well, what little nuggets, you overlooked things you can occasionally find in microcaps. It's what makes it so interesting, I think, rummaging through.
Yeah, that's really good. Okay, we've got another question from he's asking about the old Team 17. Who is it? It's Tom Hildrick. He's asking about Everplay, which is previously Team 17, which I think is a games developer. It does it for basically third parties and on its own book and stuff like that. The shares they boomed during the pandemic, but have come down, and now they seem to have stabilized. And I think if I remember rightly, they're making quite a bit of money out of their back catalogue. Actually,
this rings a bell. With the computer game stuff, I get my co-writer Dave to have a look at them, because he's got a son who loves playing computer games and on Steam all the time. So Dave knows what to look up on Steam to see if the games are selling. So that's quite useful. I think he quite liked this one, but I can't find our notes on it, I'm afraid, Paul.
No, I like it as well. I think
from memory. Go on. Sorry,
hello, Paul. Yeah, no. Sorry, I thought I'd lost you then for a moment. We went down the right. Okay, good. Let's move to another company. Let's look at one reported, which is the old Moneysupermarket.com business. Looks pretty cheap, good dividend yield. Came out with results that were better than expected, but again, the outlook seemed a little cautious. How do you see this one? Trades at a pretty cheap 12 times PE, 6% dividend yield, good balance sheet. Price comparison site.
That sums it up. Again, I think what it is, when I look up shares on this laptop, because I'm on Wi-Fi, I think it slows down the video link, so I couldn't plug it into the Ethernet because it's a Chromebook. But I had a quick, either me or Dave looked at MONY, MONY, and we thought, it looks good, looks reasonably priced. I think this is the one that generates a lot of cash. I think it was generating free cash flow of about 100 million a year. I think from memory it said that the car insurance price comparisons are struggling a little bit, but that the energy side of things could come back in if people are able to start switching their energy again. But bottom line, it's a nice cash generative business. I think they paid down all their debt, haven't they, as well?
Yeah, they have,
from the last acquisition. Personally, I've never invested in a comparison site share because I just feel the business model, there's not that much differentiation between these companies, and it's the type of thing that you could just suddenly get some bombshell from regulatory or mis-selling, or do you know what I mean? Because it's the courts and the government just seem so willing to pounce on these types of businesses that for that reason, I just want to avoid anything that's got any sort of regulatory risk. So it's not for me personally, but we did quite like the last set of numbers, which was a couple of days ago, I think. So I think 6% dividend yield, I think.
Yes, that's right. One thing I would say, if you're thinking about investing in it, is just to make sure you're happy about generative AI and internet discovery, because obviously it helps customers find the best bargain to meet their requirements. But it might well be that the likes of Gemini and ChatGPT and even DeepSeek, if you stick in what you're looking for, it comes out with an answer straight away for you, and therefore it disintermediates these price comparison websites. But hey,
that's such a good point. I wouldn't have thought of that, but it's like, funnily enough, in a family chat room yesterday, my sister-in-law mentioned Googling something, and my nephew came back with, "Oh my God, you're still using search engines." So it just shows, doesn't it? You're right. And Paul, I've got to correct you here. It's disintermediate.
Oh, disintermediate. Yeah.
You always get that wrong.
I'm terrible. Well done. Okay.
So you could be right. Maybe these business models will themselves be attacked. So great point. I hadn't thought of that.
Yeah, good. Okay, let's move to another one we don't talk about hardly ever. It's Echo Animal Health. And the reason why I thought it'd be good to discuss is that Stephen English of Stellar Asset Management talked me through it. It basically does sort of drugs for the poultry, for pigs and for chickens, etc., to help their gut and to fight diseases and viruses and stuff. It only has one product, and it's largely sold, surprise, surprise, out into China because it's big. These are obviously the big pork sales there. But the interesting bit of it is basically their R&D backlog, where they've been putting £10 million per annum into R&D over the last 5 years, and their market cap's only 40. And I've read some broker notes in terms of, this, if they can hit get any successful drug, it can get it cleared on it, then these could be enormous value catalysts which will come up into sort of like, to make a decision making over the next sort of 12 to 18 months. I don't know whether you've ever had a look at this one, because it does seem as though there's a lot of value there. I would use an analogy. We're reaching phase 3 trials on big drugs, and they've had good sort of therapeutic efficacy results so far, and you only need one of these to make a massive difference to the business.
Yeah, that's true. I mean, it's not what I'm particularly familiar with, and I haven't been able to find any not doing very well today. I haven't been able to find my notes on it, but just looking at the stock report from Stockopedia, I can see that it's profitable, reasonable sized business, 85 million forecast revenues, 2 million forecast profit after tax for the current year, March 25. I'm impressed by the price. It's priced slightly below tangible book value, and it seems to have net cash. So on those value basic measures, this looks quite interesting, actually. Yeah. I'll make a note of that and have a look at it, and we could maybe revisit it next week.
Yeah, I think it's that R&D, and to me, it appears as though the value of the business is already underpinned by an existing drug. If not, actually, the existing drug is worth more than the market cap of £40 million anyway. And then you've got effectively all the upside of that R&D pipeline, because if it doesn't work, the R&D falls away, and they generate an extra 10 million of profit a year. So
that's a good point. Well, do you know what happened in September last year? Because it seems to have, it was over £1, and it suddenly started a steep decline, and that it hasn't recovered from, and it's now 59p. So was that general background selling, or was there any news? Do you know, Paul?
I can't remember. I think it's something to do with effectively the pig sales. They had a couple of problems in Southeast Asia and China, whether it was swine flu out in China and reduced the number of sales that they could then make, because they're basically at the moment a one drug company and really a one country market company, which is China and this one antiviral. So they've got to get they need to broaden that off, and these other drugs will be able to do that, because it will go not only there'll be some into poultry, and it'll then be able to sell into the States and stuff like that. So it's broadening.
Oh, here we are. I found on 1st of October 24, the Newswire says it's a profit warning basically on the 1st of October, saying full year revenues below market expectations. So but because I don't mind buying after profit warnings if it's just some temporary fixable factor, and if they got a nice strong balance sheet, which Echo definitely does have. So I think this one looks worth us having a deeper look into it, I think, Paul.
Okay, right. Let's go to the film industry, because it's been quite disturbing of late. Let's go for Zoo Digital to start with, which basically does auto dubbing and sort of like helps people like Netflix make their films and distribute them around the world, etc. They came out with a profit warning, I think, this week, and the shares didn't respond well, and they're running out of cash. How do you see this one going forward?
Very negatively now, because obviously I was positive on the shares. So this should have a trigger warning flashing across the screen, because it seems to sets off one or two very aggressive holders of the shares, who then start personally abusing me because I'm saying something negative about a share they own. But look, it did very well during the pandemic streaming boom. and it briefly went into a fabulous profit. So obviously, me and other commentators and shareholders were very happy with it. But then it really unraveled quite quickly. They raised a load of money in a placing around 160, I'm thinking, around 150,
Yes,
160.
that's right.
To do a Japanese acquisition. But then they warned on profits a few weeks later, and the shares have just absolutely collapsed. And all that cash they raised has been squandered on operating losses. So they are now fighting for survival, I think. And the update that came through this, it was the sort of share where people keep buying it, hoping for a rebound because management are putting out a really bullish tale about revenues rising, but all you have to do, and recovery from the Hollywood strikes, from that wearing off. But you only have to look at the figures to see they needed to roughly double revenues to get it back into a proper profit. And they're nowhere near that. Revenue is rising. And the latest update, I think they're running out of cash. Well, they're obviously running out of cash. They've burnt through nearly all of the remaining cash. They reassure that, we've got, I think, only about $1 million left, or maybe slightly more. And they've got some unused invoice discounting facilities, I reckon, which they say they don't expect to use, but they would say that, wouldn't they? They've not been reliable forecasters about their own business at all. So I basically disregard all the outlook comments from management. All I do is focus on the numbers, and I think they're in trouble. I wouldn't be surprised if this runs out of cash again. So wouldn't touch it personally, even though it's only 17 million. I don't think they've got a viable business because, again, AI is so good now. Do you really need to pay actors to localize it? I know the argument is it's better nuanced but you see the new film and TV productions are not coming through to the extent that the companies like this need. And, if you're a strapped for cash TV company, are you really going to want to pay extra to have it all perfectly done when AI gets better by the day? Over to you, Paul. What's your...
No, I'm with you. I think they're going to be really challenged with AI. It's getting better every week. And on that basis, then a lot of their services, their core services, are going to be less needed. It's just be the really specialized stuff that is required. And I think they make most of them, looking at their gross margins, I think they make most of their money on that volume play, which frankly is likely to go away.
Yes.
Another one in the same vein, we had Videndum this morning, the camera manufacturer, professional production, etc. Does it for the film studios and also does it for the production houses and the TV studios. Bit of a shocker, unfortunately. How did you read it?
Well, you and I were both on this morning, weren't we? But again, in the golden hour between 7 and 8, trying to interpret, because this thing looks poised for a bounce, didn't it? Because it's just been in an absolute free fall since the first profit warning last October. I went negative on it when it was about £2.30, and it dropped intraday today to 30p. It has bounced a bit. Yeah, I know, it's down 52%. And the issue here is, as you and I both picked up on before 8 a.m., it's on a knife edge financially. The bank has waived the covenants for February, but not for March. So you can bet your bottom dollar, I would say, that this thing must be under a lot of pressure to do a discounted placing, because banks often link a renewal of the facilities or a waiving of the covenants to requiring the company to raise some cash. You did some sums on this, Paul, so let me hand it over to you.
Yeah, I mean, I was just doing some back of the fag packet type of numbers, and I thought, okay, they may, with their cost savings, they may do like 20 million of EBIT, sort of like when they get steady state, etc. And if you do assume sort of like 8% interest on that, that's sort of like 20 million, 3.6, etc. And therefore, if you do 3 times interest cover, they'll need about the sort of, that'll be 10 times. No, sorry, they've got 100 million. That's right, they've got 100 million of debt, 105. They get to 85. If they've got 8% of 80 and 85, you get to about 7 million of interest payments each year. You're 3 times the interest payments of 7, you get to around 20. So that's why I came down to 20 plus would be a minimum amount they need to raise. and it probably more than that, because to restructure, you're going to have some exit costs as well. So,
well, that's the trouble. These and the cost savings are not that big. I think they said before it was 10 million a year, and they've increased that by 5 million. But they're saying the upfront restructuring cost is the equivalent of a full year's savings. So, yeah, I think they're really in trouble, this business, actually.
No, I'd agree.
So unless and until the sort of Damocles with the bank covenants is fixed. But, just for balance, you can also say if they muddle through without doing a massively discounted placing, you could have a multi-bagger on your hands.
Yeah.
Because, well, it made 40 to 50 million a year profit in the good years. So I don't know anything about the products, though. I mean, do we know whether the products are still current and competitive, or whether they've been passed?
It's impossible to tell with China, isn't it? Electronics.
Yeah.
You're fighting against a pretty difficult and advanced competitor. In that same space, on your Substack today, there was a user asking about ADF and the read across for it.
Oh yes, this is an interesting one. I loved Christopher Mills' comments on your interview with him. I know we always quote him, but he is a fascinating chap and incredibly skillful. And it was quite, in his lovely, posh, polite way, he avoided directly saying that he'd been misled, but in the placing, I think most of us, the rest of us, would probably be more direct about it. But anyway, it's the same sector with all the facility, all the
the trailers, isn't it?
Trailers, I'm not so keen on this. I did buy after the profit warning, but I only held about 2 days because I realised I'd probably made a mistake. I don't think I'm going to revisit this, because I think the trouble is, it's all about implementation rates, isn't it? If you get gaps in between, if you have short projects and then you have a long gap in between the next project, hiring these things out is not really economic. So I'm skeptical. I'm not sure ADF profits will come back as quickly as the bulls are hoping for, but that's only really a hunch. So I'm keeping away from it. How about you, Paul?
Yeah, I'm with you. I think anything which is sort of like a beta play on film production outside is going to be challenged, given what Zoo Digital said this morning. No, it was Videndum said. It was I think it was Zoo, actually. They said basically that they were starting to see more demand, but most of the demand from the film studios was in licensing and out licensing content from other sort of like, providers. And there was very little actual original content being done outside. And that would come later on in the year. So I would stay well clear. What's sort of quite contrasting to that, or, in comparison, is the TV studios. You've had ITV studios put in a profit upgrade, and you've had STV again. Their studio business is flying. So when it comes to TV production, your box sets, sort of like, all these programs that they do really, really well. It just seems to be the film studios which is the issue. But I don't know if you've observed that at all.
Yeah, I don't really know much about the sector, but that's a good point about the studios. There's some massive new studio being built on the outskirts of London, and the TV industry has fabulous tax breaks in Britain, doesn't it? So it does attract American and overseas interest. But as you say, if they're making all these films and TV things in studios, then I'm not sure that ADF would necessarily benefit that much from that. So and ITV I hold personally. Actually, I don't know that much about the figures, but it's cleared its pension deficit now. Its pension is fully funded. It's got a 6% plus dividend yield. Balance sheet's okay. I think it looks very interesting. And there are always rumours, aren't there, in the financial press about it being bid for, or part of it being bid for. And I think it's doing very well with streaming revenues as well, ITV, if I remember correctly. So I think ITV's worth a look. Do you like it as well, Paul?
Yeah, I think it's a good sum of the parts. I think both. I think they're in the right space. TV production and those studios are crown jewels in the English broadcasting scene. So ITV's doing well. I think the BBC studios is doing very well, that commercial arm. STV is doing well, and that's why they've come to a very last one. Let's just put a bow on this whole media sector. We've got Zinc Media, which is an independent sort of film and TV producer. Now, the shares have actually climbed a reasonable amount. The market cap is very small. It's only 16 million. So we're not talking ITV standards here. But they trade at, well, basically about 30% of sales. I don't know if you ever had a look at this one at all.
I have. I did warn you that if you mention this one, I'm going to rip it to shreds.
No, please come 12, get the 12 bore out. Absolutely.
I'll give it both barrels because, yeah, I mean, this company sticks in my mind as the most extreme case I can remember of hearing a super bullish presentation from management and then looking at the actual numbers and finding that they were polar opposites.
Right. Okay.
I don't think it's ever made a profit. Management pretend that EBITDA is profit, so that's what they refer to. It's loss making every year. It's issued tons and tons of new shares because it's cash flow negative. The last set of results, H1 results, were very poor. Just to give you an excerpt from that, you know, it reported a 900k. No, but it was an EBITDA loss, but not a very big one. Sorry, I was just on the wrong page. So scrolling back up. Yeah, here we are. Adjusted EBITDA was 922k loss in H1. It looks as if H1 is seasonally slower, but that then moves down to a loss before tax of 2.2 million in H1. Now, it did say in a recent update, I think it expects 1.5 million positive EBITDA for the full year, didn't it? So it looks like H2 is a lot seasonally stronger. But you see, that wouldn't translate into a. I think that would only translate to us. I think that would actually be a loss before tax. I can't see that it's ever made a profit. It's diluted hugely. The balance sheet is very weak. It also has terrible communications. It talks about cash, but it refers to gross cash, and it conveniently ignores the fact that it's all offset by a loan. So I think their communications is very over-egged. You really do need to look at the numbers and ignore everything management say. I just totally ignore what they say. But I don't know.
I would say the bull case, if they are an independent TV, broadcaster, or studio, etc., then if you're one of the big company and you're spending 200 or 250 million pounds building a new studio, it's going to take you 5 years to do or get planning permission. Then buying a company which already does it and expanding, which is 16 million quid, would be very sensible, because you would speed up the process and it'd be a damn sight cheaper. So there is a buy and build argument here, I would say. Depending on, you'd have to know exactly, how they do it and what their equipment is and what the studios are like. Though I get it.
Okay. Yeah. Well, maybe it'll be all right. But yeah.
Yeah, we've got a final question in that whole sector. We've got Malcolm C asking a bit cheeky one on Audio Boom, which is the podcast provider. The shares have just taken off of late, largely on the back of, I think, their content providers that they spend. A lot of those deals is rolling off this year. So they're losing a shed load of cost, and they'll keep the sales, so the margins should increase. But I don't know whether you've ever had a look at this, but I think the shares have done really, really well.
Shares have done very well. The reason is it started showing improving trends, excuse me, late last year, and it's put out. They're quite clever. They've set the broker forecast modestly, and then they keep putting out ahead of expectations updates. And there's no getting away from the fact that the fundamentals are improving, but they were very poor at the starting point. So I'm not totally convinced by, and this has been, a podcasting company that's been operating for years. The flaws of the business model are that whenever a podcast that Audio Boom is sponsoring starts to take off and becomes lucrative, the podcaster will then shop around for a better deal elsewhere. So, I'm a bit skeptical on this still, but I have reviewed some of its updates over the last few months and said, look, I think there could be a good trade here. So I think for traders, this is a great share. Fundamentals, I'm not so sure about, but hell, if the shares have tripled, you don't care, do you? You've made your money and you can bank it. And so, the bulls have latched onto a story with nice momentum, I think. So I can see why this share has done well, but I wouldn't fall in love with it and think that it's home and dry and is now a wonderful business. That's all I'm saying.
Yeah, I think Lawrence Hulse from Onward Opportunities bought this one before it took off, so he's done rather well on it.
Yeah, good for him. No, ultimately, it doesn't matter how you make the money; it's
I know,
making the money, isn't it? And yeah, looking at the forecast graph, the EPS forecasts have gone up a lot. So, you know, there is some substance behind this move. I'm not dismissing it by any means.
Yeah. Okay. Right. Well, we've done an hour and 10 minutes, so we're going to have to cut it off there. Well, so thanks everyone for your questions. Very much thanks for all the insights and comments. Now, next week, guys, unfortunately, we're going to have a break. I'm taking a weekend off, so I'm leaving on Friday. So no show Friday. So it'll be 2 weeks' time that we'll have the next one. So thanks again, everyone.
Thanks everyone. Thanks, Paul.
Look forward to chatting in 2 weeks, Paul.
Yeah, great stuff, and have a good break.
Yeah.